Credit risk came up in regards to investing in foreign fintech companies and the uncertain nature of foreign non-U.S. economies. One of the companies talked about was Nubank. They have historically had a loan to deposit ratio in the 30s, currently sitting at 40%. Normally, U.S. banks have a 70 to 90% loan to deposit ratio. Do you think this lowers the risk the company has on credit, or are they still susceptible to large losses in a worsening credit environment?
Thanks for this question. I alluded to this when I mentioned our small investment in StoneCo a few years ago when they started taking on credit risk. And the problem with loan to deposit ratios is oftentimes in an emerging market, let's say Nubank or StoneCo or Mercado Libre, take your pick. In a credit risk event, the default rate will tend to be much, much higher than, let's say, a market like in the US. Generally speaking, the default rate can be much higher. The coverage rate isn't an automatic savior for these businesses. That's kind of what initially got the ball rolling on the undoing of StoneCo, for example, a few years ago, was the introduction of this credit risk event, a wave of defaults. And then in tandem with that, you had changing regulations in Brazil, digital payments, and what constituted payments recognition, what could be used as collateral and what couldn't, currency exchange risk on top of that. Some of these risks can get really exotic. And so the higher coverage ratios aren't a silver bullet. It makes the hair on the back of my neck stand up a little bit when companies wade into credit risk for the first time and say that they're really, really good at it because they have great data on their customers. Here's the problem, especially when a company like StoneCo or Nubank does this and they're in a developing or emerging market or whatever moniker we want to give it. I don't really like those terms, but you know what I'm getting at. In a lot of those markets, especially if it's consumer credit, a lot of consumers in those markets don't even have a traditional bank account. That's part of the problem that these companies are trying to solve for, is trying to get more people to participate in the banking system. That's a good and healthy thing. It's good for the consumer and it's good for the economy that they live in. And the problem with a company saying we have lots of data on them because of some activity that's embedded in their app. For StoneCo, it was digital payments, and especially for their enterprise customers or their merchants, payments acceptance data. For Nubank, it would be the actual consumer data. I imagine that they're saying we have lots of data on, and so therefore we're really good at this credit risk thing. This is a problem with these companies. This is something that also happened with PayPal. That's still something that most investors are not talking about. There's credit risk with PayPal. That deserves a discount versus a high growth, high margin digital payments company. It's a different type of risk, and it's an additional risk that a pure tech company or a pure digital payments company or a pure e-commerce company doesn't have to deal with. But now you suddenly introduce that and you have a new exotic risk in addition to all the other risks that the company has, and it muddies the water and can cause problems. My short summation here is whenever you have a high growth company like this, they're turning a profit, they're doing really well, but the valuation is also very high, and suddenly you introduce credit risk into the equation, I think you need to start thinking about a multiple contraction to account for the credit risk.